You ever open your banking app, see the numbers sitting there, and feel a strange sense of relief? Maybe it's $5,000. Maybe it's $20,000. Maybe it took you years to build it. You remember the sacrifices, the skipped trips, the late nights, the side hustles, the "I can't afford that right now." And when you finally see that balance, you think, "I'm safe." But here's the uncomfortable question nobody really asks out loud. What if your money is quietly shrinking, even though the number isn't changing? What if the real threat to your savings isn't a bad investment or a market crash, but time itself? Because inflation doesn't scream, it whispers, and most of us don't hear it. When people think about losing money, they picture dramatic things. They think about the stock market crashing like in 2008. They think about someone getting scammed. They think about making a bad investment. So the natural reaction is defensive. I'll just keep it in savings. I don't want to risk it. At least it's safe there. And I get it. Safety feels good. But here's the misunderstanding. Risk doesn't only mean volatility. Risk can also mean stagnation. If your money is sitting in a bank account earning 0.5% or even 1%, and inflation is running at 3% or 4%, you're not standing still. You're moving backwards, quietly. Let me make this simple. Imagine you have $10,000 sitting in a savings account. It stays $10,000 for the next 5 years. No withdrawals, no emergencies. It feels stable. But if prices rise 3% per year, that same $10,000 will only buy about $8,600 worth of goods in today's terms after 5 years. Nothing dramatic happened. You didn't make a mistake. You didn't panic sell. You just let it sit. And inflation did the rest. This is why inflation is so dangerous psychologically, because it doesn't feel like loss. There's no red number on your screen. There's no alert notification. There's no pain signal. Your brain sees the same balance and thinks, we're fine. But your purchasing power is slowly eroding. And purchasing power is what actually matters. Think about everyday life. Groceries feel slightly more expensive. Rent creeps up a little each year. Gas costs more than it used to. Streaming subscriptions go from $9.99 to $12.99, and you barely notice. Individually, these changes don't feel catastrophic. Collectively, they reshape your entire financial life. If your income doesn't rise faster than prices, your lifestyle slowly tightens. You feel like you're working just as hard, maybe harder, but getting slightly less breathing room. And here's where the emotional part comes in. Most people blame themselves. I should be earning more. I should be saving more. I'm falling behind. But sometimes it's not just about effort. It's about the system you're operating in. Inflation is built into modern economies. Central banks like the Federal Reserve actually target around 2% annual inflation as healthy. The idea is that modest inflation encourages spending and investment instead of hoarding cash. From a macroeconomic perspective, that makes sense. From a personal finance perspective, it means one thing. Cash loses value over time by design. That doesn't mean cash is bad. It just means it has a purpose. An emergency fund? Absolutely. Short-term expenses? Of course. Peace of mind? 100%. But long-term wealth storage? That's where the conversation shifts. Because if you leave long-term money sitting in low-yield accounts for 10, 20, 30 years, inflation compounds against you. And compound growth works both ways. We all love hearing about compound interest. We reference it like it's magic. You've probably seen charts comparing someone who invests early versus someone who waits. The earlier investor ends up with dramatically more. But inflation compounds too. At 3% annual inflation, prices double roughly every 24 years. That means something that costs $50,000 today could cost around $100,000 in about 2 decades. If your savings didn't grow, your future just got more expensive. Quietly. This is why older generations sometimes say, back in my day, a house was $80,000. They're not exaggerating. It was. But wages and investment returns evolved too. The people who invested in businesses, real estate, or broad markets didn't just fight inflation, they rode above it. For example, the long-term average annual return of the S&P 500 has historically been around 7 to 10% before inflation. After adjusting for inflation, that might look more like 6 to 7% real returns over long periods. That gap matters. If inflation averages 3% and your savings account earns 1%, you're losing 2% in real terms every year. Over 1 year, that's barely noticeable. Over 20 years, it's the difference between momentum and erosion. And here's the psychological twist. Humans are loss-averse. We hate seeing our money go down. So we avoid volatility. We avoid markets. We avoid risk. But in doing that, we sometimes accept a different kind of loss, one that feels safer because it's invisible. It's like putting your money in a drawer and hoping time will be gentle. Time isn't gentle, it's consistent. Now, I want to pause for a second, because this isn't about shaming anyone who keeps cash. There are seasons in life. Maybe you're building stability. Maybe you just paid off debt. Maybe you're recovering from a layoff. Cash can be the most powerful emotional asset you own. It lets you sleep. It gives you options. But once stability is in place, the question becomes, what is this money for? If it's for next month's rent, keep it liquid. If it's for a home down payment in a year, protect it. But if it's for 20 years from now, retirement, financial independence, freedom of time, then inflation is competing with you, and you need something competing back. This is the turning point most people eventually have. They realize the goal isn't to save money, it's to preserve and grow purchasing power. That shift changes everything. Instead of asking, how much do I have, you start asking, what can this buy me in the future? Instead of chasing the highest savings rate, you think about allocation. You start seeing money as energy that needs to be deployed with intention. Not recklessly, not emotionally, but strategically. And that doesn't mean you suddenly become a stock-picking expert. In fact, the simpler the system, the better for most people. Broad diversification, low-cost index funds, retirement accounts that offer tax advantages, automatic contributions so you don't rely on willpower every month. It's boring, but boring compounds, and inflation doesn't care about excitement. It just keeps moving. Here's a simple mental model I like. Think of inflation as gravity. If you do nothing, gravity pulls your purchasing power down slowly. To stay in place, you need thrust. To move upward, you need consistent lift. That lift doesn't have to be dramatic. It just has to outpace gravity over time. And the earlier you start, the less force you need, because time, when it's on your side, is powerful. But when you ignore it, it still works, just not for you. I've talked to people who kept large amounts of cash for years because they were waiting for the perfect time to invest. They were waiting for markets to calm down, for headlines to feel less scary, for the economy to look clearer. But clarity in real time is rare. There's always a reason to hesitate. Meanwhile, inflation kept moving. The irony is that the very thing they were trying to avoid, loss, was already happening, just quietly. And again, this isn't about jumping into anything blindly. It's about understanding the invisible forces acting on your money. When you understand inflation, you stop seeing investing as gambling. You start seeing it as participation. Participation in businesses that raise prices, participation in productivity growth, participation in the economy itself. Businesses adjust to inflation by increasing prices. Investors, over time, share in that growth. Cash doesn't. Cash absorbs it. That's the quiet trade-off. So what does this mean for you practically? It means build your safety net first. A few months of expenses, enough to handle life's curveballs. That's not optional. That's emotional stability. Then start asking long-term questions. Is my money positioned to grow faster than inflation over decades? Am I relying purely on savings accounts for goals that are 15, 20, 30 years away? Am I confusing comfort with security? Because real security isn't just seeing a stable number today. It's knowing your future self won't feel squeezed. And none of this has to happen overnight. You don't need to move everything tomorrow. You don't need to predict the market. You don't need to become obsessed with charts. You just need a system. Automatic investments, gradual increases, patience. Small adjustments that over years compound into resilience. That's the calm way to approach it. Inflation will continue. Prices will rise. Your favorite coffee will cost more in 10 years than it does today. That's not a crisis, it's a pattern. The question is whether your money is rising too. Because if it is, inflation becomes background noise. If it's not, inflation feels like constant pressure, and pressure creates stress. Money stress isn't always about earning too little. Sometimes it's about positioning poorly. Sometimes it's about letting invisible forces chip away at progress. But once you see it, once you understand that inflation quietly steals savings when they sit idle, you're not powerless, you're aware. And awareness is calming. It means you can respond slowly and intentionally. You can respect cash for what it's good at. And you can let long-term money work where it has a chance to outpace the quiet erosion of time. You don't need perfection. You don't need to maximize every dollar. You just need progress. Because in a world where prices keep rising, standing still is the only guaranteed way to fall behind. And the good news? You don't have to run. You just have to move. A little. Consistently. Over time, that's enough. If this video resonated with you, the next one goes even deeper. Click the video on your screen now. You don't want to miss it.